Tyler, I think this is a great question because I think it does bring in, the idea that there are more durable components to the inflation sector that may not come down as fast. Inflation may still be anchored, but it may not come down as fast. The Fed really has a problem with the price of money, and this is what Bob Pisani was alluding to just now. Essentially, if we think about it this way, the Fed's baseline policy forecast for the long term is that the Fed funds rate will go to 2.5%. The market is pricing the terminal Fed funds rate at closer to 1.75%. So here we are talking about tapering, and we have to understand the sequencing here. You have to taper first, get done with tapering, and then start hiking interest rates. And what the market is saying is that once you get done with tapering, the Fed's not going to get to their long-term goal of where their terminal policy rate around 2.5% ought to be. So what this is creating is this view in the market that money is going to be cheap for an extended period of time. Now, we understand the technicals, and we brought up the standing repo facility earlier, and there is a lot of money coming into the markets right now. This money needs to go someplace. We also have the debt ceiling issue that's coming around as well. The Treasury general account is also being run down. There's not a lot of net issuance of U.S. Treasury securities. In fact, in the second quarter was close to zero. This is depressing interest rates artificially, I think, at this point. I think rates should be higher, but they can stay around these levels. 10-year yields can stay around these levels, if not drift a little bit lower, for an extended period of time before they make their move higher, which I think is going to be in the fourth quarter.
Steve, jump back in.
Yeah, I just want to make a point here, Tyler, that make sure that we're all looking for the same thing here. Prices are going to go up, and they are going up, like, say, 5%. Inflation does not continue if they go up zero the next year. They're not supposed to go back down. It would be good if they did in some cases, but in general, that's not what the Fed will be looking for. The Fed will be looking to see that they don't go up at the same pace. So prices go up, and the gentleman is right there. They don't necessarily go back down, especially when it comes to labor. Labor prices are thought to be sticky. But don't look for prices to roll back to think that inflation is gone. No, you just don't want to have the same increase in inflation that you've had. So that would be the key that the Federal Reserve will be looking for. And that's why what Powell did is he sort of set out a 6-month time frame. By the end of the year is when he expects these prices to roll back. And you do see things like the big trade deficit you had this morning. There is restocking going on. There is going to be a period in the second half of this year, which we're in now, of inventory rebuilding. And that should help with prices as we go forward.
Alicia, just a word on what you think the market's going to be listening for in this press conference.
Yeah, so I think it's really interesting because, again, we'll drink a beer every time we hear transitory, but I think the definition of transitory has changed. So originally it was several months, and now we're looking at several quarters. And if you listen to business leaders, and this is something that Bob Pisani just spoke about, corporate margins are the highest ever, and all S&P companies that have reported, most of them they're essentially telling us they're passing costs on. So what does that mean? That means market pricing of inflation is very benign and has come down over the last few weeks. And at the same time, inflation in the real economy, and if you speak to business leaders, will move forward. Now, it is true that if your prices rise at a slower pace, so the second derivative is going in the right direction, then you should be able to call victory on inflation. But we think that inflation will end up at a higher rate than in the post-global financial crisis world, simply because we do have higher pressures here. The labor market is not going to heal so quickly. There's clearly a mismatch between what is demanded, where labor is, and also the skill set. And so to that extent, the Fed has really made better progress on its inflation goals than it has on the unemployment goals.
Let me turn to you, David, and get your general reaction to what we've been talking about. But I asked the question sort of half jokingly, Daddy, why are bond yields so low? I don't understand it. If inflation is up, the economy is hot, why are the yields so low, Daddy?
Well, I think Jim's got it right. There's a lot of technical factors here. We're running these big deficits, but actually in the second quarter, there was virtually no net issuance of treasuries to the public outside of the Federal Reserve. And that's because we built up a huge stockpile in the Treasury's checking account of the Federal Reserve. They've been sort of working down that over the second quarter. And now we've got the debt ceiling issue, which is going to, again, probably prevent the Janet Yellen from borrowing more money in the next few months. So there is a technical issue here, but on this issue of transitory, I do think inflation, we've got a somewhat sticky situation here. I think that some of the inflation will go away, but it's not just wages. I think inflation expectations have gone up, and that's very important because inflation can be a somewhat self-fulfilling prophecy. And one other thing, a big part of inflation is owner's equivalent rent. And we've seen huge increases in home prices. That's going to be followed, we believe, by some increases in mortgage rates. That means the carrying cost of rental property is going to go up. And so our models are saying we're going to have some pretty high owner's equivalent rent increases over the next few years, and that will make inflation sticky. So I think we are back to sort of a new old normal of inflation running above 2% for a while here. That's not a terrible thing. I'm more worried about asset bubbles being created by just too much liquidity sloshing around than I am about inflation overall. But I do think we're looking at higher inflation in this recovery, this expansion, than after the last one.
Shepard Smith here. Thanks for watching CNBC on YouTube.